Welcome back. In this quick CPA review, we are covering notes to the financial statements which provide the disclosures required by generally accepted accounting principles. They do not correct errors or replace the financial statements. Instead, they provide additional information that helps users understand the accounting methods, assumptions, estimates, uncertainties, risks, and significant judgments used in preparing the financial statements. Think of the notes as answering the question, if someone only looked at the financial statements, what important information would they still need to understand them? One of the first notes is usually titled, The Summary of Significant Accounting Policies. This note describes the company's most important accounting methods and policies. Remember that it discusses methods being used, not the financial results. Only significant accounting policies are disclosed, not every accounting policy the company has. The summary of significant accounting policies includes the basis of presentation, such as whether the financial statements are prepared using the accrual basis of accounting, whether the statements are consolidated, whether the company is considered a going concern, and its use of accounting estimates. The going concern assumption means the financial statements assume the company will continue operating normally for the foreseeable future, rather than shutting down or liquidating. If there is substantial doubt about the company's ability to continue operating, additional disclosures are required in the financial statements. It also explains the company's revenue recognition policy, including when revenue is recognized, whether revenue is recognized over time or at a point in time, significant performance obligations when applicable, and significant judgments used in applying the revenue recognition guidance. For inventory, the summary discloses the company's inventory valuation method, such as first in, first out, last in, first out, or weighted average, along with any significant inventory accounting policies, including lower of cost or net realizable value, or lower of cost or market when applicable. For property, plant, and equipment, the summary discusses depreciation methods, estimated useful lives, and capitalization policies. For intangible assets, it explains amortization methods, useful lives, and impairment policies. For leases, it explains how leases are classified as operating or finance leases and summarizes significant lease terms. For investments, it describes how investments are classified, such as trading, available for sale, or held to maturity, how fair value is determined, and the company's policy for determining which short-term investments qualify as cash equivalents. The criteria used to determine which investments are treated as cash equivalents belongs in the summary of significant accounting policies. For income taxes, the summary explains the accounting policy for current and deferred income taxes, deferred tax assets and liabilities, and the company's valuation allowance policy. It is also important to know what is not included in the summary of significant accounting policies. It does not include detailed depreciation schedules, amortization schedules, maturity schedules for debt, internal management strategies, forecasts of future profits, speculative information, or minor accounting policies. Remember, the summary explains how accounting is performed, not the detailed numbers produced by those methods. Separate footnotes disclose information that does not belong in the summary of significant accounting policies. For example, guarantees of another company's debt belong in the commitments and contingencies note. Pension information belongs in the pension note. Debt refinancing after the balance sheet date belongs in the debt or subsequent events note, rather than in the accounting policies note. A common question that is asked on the exam is whether information from the summary of significant accounting policies should be repeated later in the notes. The answer is no. The accounting policy is disclosed once in the summary of significant accounting policies. Later, footnotes provide the detailed amounts, calculations, schedules, and additional information related to specific accounts, but they generally do not repeat the accounting policy itself. Another important disclosure topic is vulnerability due to certain concentrations. Companies must disclose when they are highly dependent on one customer, supplier, geographic area, product line, industry, or market, creating a significant concentration of risk. Disclosure is required only when all three conditions are met. First, the concentration exists at the balance sheet date. Second, the concentration makes the company vulnerable to a severe near-term impact if that source is lost. Third, it is reasonably possible that the event causing the loss could occur in the near term. Notice that the standard is reasonably possible, not probable. Actual losses do not have to occur before disclosure is required. Examples of concentration risk include one customer generating a large percentage of sales or accounts receivable, reliance on a single supplier for critical materials, operations concentrated in one geographic region, dependence on one product line, or receivables concentrated within one industry. Companies disclose the nature of the concentration, how the company is vulnerable, and the financial statement line items or related financial statement amounts affected. They do not disclose customer names, supplier names, dollar estimates of potential losses, probability estimates, or speculative outcomes. Finally, remember that disclosures often accompany recognition and classification questions. For example, if a short-term note payable is refinanced on a long-term basis before the financial statements are issued and the refinancing qualifies under generally accepted accounting principles, the liability is reclassified as non-current, and a note disclosure explains the refinancing. Both the accounting treatment and the disclosure are required. To summarize, remember these key ideas. The summary of significant accounting policies explains the company's significant accounting methods, not detailed results, and it is usually one of the first notes to the financial statements. Later footnotes provide account-specific details without repeating the accounting policies. Required disclosures provide users with information about significant accounting methods, risks, estimates, uncertainties, and concentrations so users can properly understand the financial statements. Whenever you see a disclosure question, first ask yourself, is this explaining an accounting method or explaining detailed information about a specific account? If it explains the accounting method, it usually belongs in the summary of significant accounting policies. If it explains detailed amounts, schedules, or events related to a specific account, it usually belongs in that account's separate footnote.